Good evening, folks. Hope everybody is doing well. Welcome to Predicted Trades. Tonight, we are here to talk about the Hull Moving Average. So let's jump right into a chart. Currently, we're looking at the Russell 2000, the Ruddy, on Friday, December 29th of 2023. And we are going to take a look at what Hull moving averages look like. So just looking at the day, we opened a little below our overnight open. Currently on the chart, you can see the Beast tool, which provides our key levels for the day. And you can see that we open down below our open from the overnight session, which is the white line. We saw a nice little bounce up to try to get there, but we never quite got there before rejecting and rolling over past our destination buy zone and outside of the Beast tool. So what I would like to do is start by throwing on some key Hull moving averages. For me, the foundation of Hull moving averages starts with the 35 Hull length and the 55 length. For me, those are my fast MAs, and they kind of provide for me the trend and direction of the day. And then I also have some slower moving averages, and basically just to make the point, I took the 35 and multiplied by 10, so the 350, took the 55, multiplied by 10, so the 550, right? So I've got a set of slow moving average, or I'm sorry, a set of faster moving averages and a set of slower moving averages, all of them Hull based. So we'll go ahead and turn those on so we can see them. Man, this was loading so fast. There we go, before I started recording. So now, as we look at the day again, we open below our slow MAs, the 350 and the 550. Our nice little bounce that didn't quite get to the open ran into that band of Hull moving averages and started to reject once. It held the fast hulls and caught a bounce back to reject twice. Then we start closing below the fast moving averages and the sell-off begins. And as you can see, every test of the fast moving averages, the 35 and the 55, resulted in another rejection and a step lower. Once we finally set in a low of day that was acceptable, we started to bounce. Buyers started to step in, and we started to see our closes over those fast moving averages. We got a nice little retest to tap them right as they were about to turn from a downtrend to an uptrend. And from that retest, we got a nice bounce, came back for another test and held, and we start riding up our moving averages, right? Our Hull moving averages. Once we start breaking through the fast, we ride them up to the slow again, which have slowly come down to meet average price over time. Basically every moving average is just an average price over time with different math applied to it. And we've made videos and indicators around exponential moving averages and simple moving averages. Ultimately, the point that you want to get across is that the simple moving average is less elastic, right? It's going to follow price action, but it's not going to move dramatically with price action. Now, your exponential moving average can move a little bit more. It's a little more elastic. Call it medium elasticity. It tries to follow price action and be support or resistance until such point that it breaks through, right? The difference with Hull is that it's, let's say, the most elastic. It's going to follow immediate price action much closer and also be that support and resistance. And then once we start breaking over, algorithms in the market start turning on to say, oh, we've broken over our fast holes. Let's do some retesting and set up a position. Let's start to reverse back up and keep holding those holes and follow it to previous price action, right? And this works, obviously if we're looking at an uptrend or a downtrend. Today we're obviously looking at a downtrend, but the overall point being that it's used to identify the trend and to recognize a change in trend, and it can most of the time give an earlier detection than your simple and exponential moving averages. The key difference being that holes become resistant sooner because they are more elastic. If we were looking at an exponential moving average, we might have rejected and it would have slowly drifted out here more kind of at a 45-degree angle, and we would have finally been breaking through right about here once the base has already been set in. The point of a whole moving average, based on the math, is that we're going to see the breakthrough, the hold, and retest the change in trend, and you're going to be getting in at a better low or a better high, depending on if you're trying to change trend up or down. Once we start to have candles that close on the other side of a whole moving average, we should be wary of a change of trend. Continued closes below and a failure to close above on any retests can indicate a change in trend from up to down, for example. And this is kind of best personified in the fact that we had a down day here. We fought above our fast MAs. We got up to our slows and started to reject. Once we had another close below our fast MAs, you can see that any attempts to try to bounce did not get back for a retest. The next bounce could not get back for a retest. We're at a key level on Beast. So in a way, you're risking against this Beast level at 2073, risking against these MAs. If we'd have bounced back above them and held above on any retests, they would have flipped long and carried us through. But ultimately, closes below, we want to be wary that we're changing to a downtrend, and failed attempts to get back to just adds to that thesis. So closes above or below are very important. And then what happens directly after those candles lends to either thesis, right? Close below, we need to get back above to continue an uptrend. We reject a lower. We start to bounce, we need to get back above to have any uptrend, and we reject lower. So pretty much on this H, we got down to a low, caught a little bounce, started to take it out. You can see even on the open and closes, it was right at the bottom of that H. This last reach up hit the bottom of that H and close lower. All confirmation that it's time to break down. We close below the whole moving averages, and they are the resistance that will lead us down to the next shelf where buyers step in. I like to use a fast and a slow hole because it can help to identify liquidity targets during a change in trend. For instance, the slow hole is what we were falling under and resisting pre-market. Every bounce got near it and rejected for new lows. Even at open, we couldn't get through that slow hole, which is a huge liquidity pocket and is based on the highs from pre-market, right? We can't get through pre-market even on the rush of volume that comes in at open. We still can't get through. So it's a huge indication that we're going to retest these lows, retest that low from the opening candle during the cash session, and then try to travel lower. The selling pressure will start to build as all of these key rejections start to unfold. So ultimately, I like to use a fast and a slow hole so that, once we start to get our candle closes above or below a fast one, we can start to get ready. For instance, this pop looks good, right? We need to hold these fast ones. We do, and we start to bounce. So that's where buyers are trying to build a position. But the second we break through them and close below them, everyone's changing directions. Even the algos on the market that are driving all of the robotic trading are starting to recognize that key change where the close is below those whole moving averages and below all of these tiny little lows from pre-market where they were trying to hold, right? They fought back above, they held. Now we have closed below all of that. You need to recognize when the signs are telling you there's no strength in these buyers to get through the resistance that exists from the whole moving averages. So, anyway, we reject, head on down, but once we start to break above, we can see buyers stepping in. We're holding those holes and riding them up to test the slow moving averages. As we go to the end of the day, you can see that we basically chopped in a very tight range, about 2055, 2060, down to 2048. So from basically 11 a.m. until about, call it 3:30, stuck in a tight range that we slowly got up and hit a sell wall and just sat there. But ultimately, we're looking at our slow holes. We just got through, held because the signals from the hole, at least in this whole premise, with the whole moving average, we are closing above. We are trying to hold and close above, where they are building a position of buyers that get a response. They start to take profit, keep buying into those slow moving averages, get a few closes above, but then break below, and you can even see the fast holes have gotten all the way to their very tight, right at that last slow hole. And then we get the breakdown. End of day for the last 30 minutes. Takes us through the previous high of day and closing at new lows. This is true basically for any vehicle and any day that these whole moving averages are going to be giving you some good indication, right? The previous day, we open and go up above our fast whole moving averages. When we have any pullbacks off of sell zones, we hold those fast moving averages and start to have an uptrend, almost like a wave in these whole moving averages. We're riding that wave up till we get to the open range sell zone. We get a stiff rejection. We start to break through and get closes below. And it's always interesting to see the candles, right? We get a close below this 35. We reach up to try to retest and get through. They push down and close below. And these are 3-minute candles. So you know that they had an effort there on a few candles to try to get back above and keep going. They fail. It starts to signal those algos again to start selling. They break through the 55, closing below, get one more retest, and what you get is this very nice apex. That's something we definitely want to focus on when it comes to whole moving averages. It's down at the bottom, so I make sure I don't forget. The apex is very important. Every time we have a good trend, those holes are going to be following us. But once we start to break through and close below, I emphasize the close because algos act to that close, right? We get a close here at open. We get some attempts to move up, but the closes are lower. The algos keep pushing, right? Even our reach back up, we can't close above the previous sell candle. But overall, what I want to point out is the apex in each of these becomes very important with a whole moving average. Since it is more elastic, you're going to get more of these waves up and down. And it comes to the point where, you don't have to necessarily be right on the day. Let it start to prove itself. Pull back. If it keeps closing above, hey, it's worth a shot long. You get a nice push, you're riding the up wave. Locking some profit on retest, maybe adding, you're still riding the up wave until we start getting consecutive closes below, right? If you look at this entire move up and all of these closes of these candles, we're not really closing below the whole moving averages. That is the key thing with holes, is to watch those closes. You take a shot here on a long, and at the close of that one or that 3 minute candle, you're already in profit, right? You maybe even are adding to and building more position and locking more profit near previous wicks. And on retests, as long as we don't close below, it's a good shot to keep going and riding that wave. Once we start closing below, retest can't get through, you should be locking, you should be attempting the short, which quickly gets confirmed within a candle or two, right? You're locking profit, maybe shorting and adding on the bounces. You're riding the next wave down. And this kind of repeats day in and day out, right? We start to get closes. Look at all these candles, none of them closed through an MA, but the first one that does, you could maybe say this one, quick retest, and then within a candle or so, we're closing above. We're bouncing through recent highs. You get a retest as they start to flip an apex, but we're riding them up with pretty much no closes below. And if you do get a close below, you usually get a quick response for that continuation. But when you get a close below and then a second, they add two. You get those hard drops down to the next key levels. So, I mean, those are the basic concepts when it comes to whole moving averages, right? We're always trying to identify and ride the wave. And as we, a lot of times at open, we'll have our holes all bunched up. We let some price oscillate, it'll start to stretch them out, and then we can get clearer signals, right? We get some closes below, we get that attempt to get back above, and we get 1, 2 closes back above. Then the next candle negates those two. So even if you caught some longs here and it's looking good, you need to recognize close below, close even lower, time to close at break even on the long and flip short to catch this down wave to the next level where you start to settle, get a close above, strong response, little retest as there's an apex. The apex is something you always want to look for on the hole as you're trying to break through. Whenever there is an apex, you likely get a little pullback to try to retest the holes again. Sometimes you get the support, right? But it happens quite often. When we flip into a downtrend here, strong response to follow it, bounce back up to those holes, and only a candle or two, one candle closing above, then quick response against. They weren't ready for the bounce back and to just take off. The holes are resistance and the closes matter. Another key thing with those whole moving averages is to wait for them to arrive at key levels, right? Just like earlier here, where they're very tight, when they start to stretch away from each other, watch what happens when we get a hole near a key level. That can be a key sign closing below and a rejection and lower high. When the hole has already come to meet the key level, they're going to sell it to bring it down. And is it time to go long yet at our buy zone? Well, let's wait till the hole gets there. Waiting, waiting, waiting. It's about to get there. Oh, we're already falling through on these candles. By the time it gets there, we're setting pretty much our low of day, right? Time to go long yet? You can risk here, but why not wait till the hole gets down? If you wait and wait, by the time it gets here, you're breaking back through. So I like to use the whole moving average as a timing mechanism as well. To say, is it time to go short? Is it time to go long? Let's wait till the hole gets a little bit closer to my key level because it is resistance. You'll see a bounce that looks good. It's coming down near. Okay, I think I'll take a long. Then we start diving again. So if you wait till it actually gets there, you can sometimes dodge these bullets, right? It's getting down here. We're on some tight doji candles at the low of day, and the hole is getting very close. The next pop up to close above, and look, we're already taking out these other dojis and candles near low of day to where you'll get your signals to flip long on algos that are starting to get underwater as they loaded right at the lows. So they buy back to get out. You get a quick response. And basically, these holes are very elastic. They're going to follow us, follow us. When we start to break and close, we need to start getting ready the other way. And it works until it doesn't. We're breaking below, switch short, right? You lock some profit near key levels, come back for a test, add, as long as we don't break these recent highs in these holes and close above, keep going. Oh, we broke above, tight risk, quickly get out and flip, and you're still following the trend. Is it time to short yet? Wait for these holes to come up near those key levels. We fall back to them. We have to ride up here. Buyers need to step in, get through these recent highs, and continue to the next targets. They fail, closes below, closes below. Sellers step in. So we can pull up a number of charts. In fact, let's go ahead and just load up ES. Excuse me. So if we load up ES, the S&P 500 futures from that same Friday, very similar scenario. We opened, I'm sorry, below our slow moving averages, our 350 and 550. We climb up to try to get above them and closed above them just for a candle, then reject lower, getting through the fast, coming back and retesting fast and slow, and closing lower. These are the big signals to watch for with a hull, right? We needed to get through, hold, get through, hold, and take off. Instead, we start closing below, closing below. These are already oriented down and they are resistance, likely from pre-market as well, right? There you go. They flipped pre-market from a long to a short on the slow, and we reject them when we get to them, setting new or getting back near the overnight low right before open. Whoa, I jumped too far. There we go. There you go. So yeah, overnight they were supporting us and taking us up to our sell zone. As they arrive at our sell zone, we break through, fast and slow diverge. Now it's resistance. Every time we get to it, even right at an apex of that uptrend to a downtrend on the slow holes, we reject there, move back below the fast. Come on, Toss. Don't jump around that much on me. There we go. And there you go at open. We get that nice push above, holding, 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 but only get that close above the slows before back down. And our holes are pushing us, right? When is it time to go long? Let's wait till our holes get near us. Let this bounce happen. If we get to the holes, you can even try a short there to retest the lows, and it's a small risk. If we pop through and close above, hey, maybe it is time to flip, but you get your rejection. Is it still time to go long? Let's wait till the holes get here. They're riding down. Here could have been a great point to hold, break through our holes, start to set higher lows, and flip them into an up wave. But we could not hold, broke that previous low, closed below. We're in a free fall, rejected the holes, right? So is it time to go long yet here? Let's wait because the holes are way up here. And you wait long enough, and as you're still contemplating the long here, the holes are right there. So you can go with the trend and say, I'll short this little doji on the next. As long as we don't break above this hole, I'm still in the trade. And on that one candle, you're confirmed for a small risk. Either way, we reject down, start to get some closes above, reject further to do a retest as things are starting to flip. And they love to do this near a low of day. In fact, it's very much like a inverse head and shoulders, right? Here's your shoulder at this low near 4802-ish, or 4803, let's call it. Bounce, come back to test, try to hold, break through for the head, get back above, and then retest that shoulder again at 4803, right? This last wick before taking back off. So either way, we start to break through here. You have your closes, so buyers start to step in. They're very often with holes, when we're getting them to apex and flip, you will get a retest. Where they try to hold, try to prevent the H, get a double bottom, and keep going. In this case, we did close below, caught a little bit more of a downtrend, but again, once we start closing back above, push above, closing above, and taking off. So it's a lot to do with the timing. That's why I love the whole moving average, because it can teach you the patience. It can say, let's wait until the hole comes down to meet us. Is it time to go long yet? Look at the distance between, not ready. Here's a chance right here where it's nice and tight. The long failed, you go short, right? If you aren't already. We start to see some closes over, time to go long yet. Wait for a retest, right? That's what I love to do if I didn't catch the breakthrough. Okay, it's starting to take off. I want to get in, but I'll wait for any kind of retest of the recent low or this hole as it's starting to flip and become support. But overall, the point is, we get so many waves per day, and the whole moving average being a little more elastic and more prone to become resistance quicker as a moving average that follows price action. I like to use it, one, for a change in trend, because the rules can be very simple. Closes getting through and response in the same direction means algos are turning on, right? We can get our retest very often, so it's worth waiting. And if you even look, once we got through and couldn't set these highs right here and started to break back down, once we got back through and touched our slow hole, the pullback we got was just to retest those highs as we retested our fast holes to continue through. Let's look at anything else like a SPY. So very similar to ready in ES, trying to get through, breaking down, rejecting the retest, heading lower. We can even jump back to previous days. Let's look at more of an uptrend day. Here we go. So SPY opening below these slow holes, but quickly jumping above the fast and the slow, holding both on the crossing and the retest of this open range sell zone. We ride the fast up. Once we start to close below the fast, you get your short downtrend where we hold the slow once, twice, start to take off again. And for the rest of the day, we'd get back above, ride for so long, we get a close below, a rejection, we get a slight pullback, buyers step in again, we get above, this rinses and repeats, but those closes below and above can be so important on a whole moving average. um, can you play a whole moving average like you do, let's say, an exponential moving average where you're waiting for it to do a retest and you're buying the bounce? Yes, you can, but given the day, given the time frame of your chart, it can be a case much like this where we're breaking above, we're breaking below, we're breaking above. We're not really getting hard takeoff. It's a slow grind, right? Can we pull back and hold? Yes. Can we pull back? Where's another example? Pull back to hold, break through, and start to look like we're going to break down, but hold other things like the slow, like a trend line from the lows, yada yada. Um, Overall point being, since they are more elastic, they're going to try to follow a time-based movement with the price. And if price continue or fails to continue at the same pace and time continues to tick on, that's when you'll get the closes below and the breakdowns, right? So a big key point with the whole moving average is that time is a huge factor. I know this is obviously key with any moving average, but with an exponential or a simple, you kind of get a little, I'll say, lazy with time, where you're not trying to keep track of, is price moving at a rate? Is it starting to slow down as time creeps on? We're running into a sell wall. How much time can we spend at a sell wall before breaking through versus a reversal back down? And what are the key signs of a reversal back down? At any of these dips, we could have closed below the slow and started a sell-off to get back to other buy levels, but continued tests of the slow, closes above, just means buyers are present, they're still buying. It's similar to a VWAP. I like to try to treat the slow whole cloud or zone that I create with the two slow moving averages. I like to treat it as like a huge liquidity pocket, very similar to a VWAP, a volume weighted price average or average price, but based on the whole math, the slow that I try to set is very similar, and a lot of times VWAP will overlap, but you get the same kind of treatment. They keep buying at it. It means they want to keep raising the price. You get that slow grind up, that extreme blow off the top, the pullback, and where do we close? Right at that liquidity pocket. Test the bottom, back to the top, and we close right there. I mean, we see this time and again with the whole moving average. I mean, even here on a choppy day, we open below them, we catch a nice wave up. Once we start to get the closes below, see, look, close above, all these closes are above. That's algos trying to buy in, trying to bait retail. Then you start getting wicks back, closes below, can't get through, closes below, one test again, and then a huge drop. So you'll see this time and time again when you load a whole moving average, and even if you change time frames. Let's move to something like a 1 day, and maybe I'll even give it a few days so that we can compare more than just yesterday. Yeah, this will take a second just to load. So we were looking at a 3-minute. Let's look at a 1-minute chart, right? We catch that little uptrend in the morning until we start to break down and close below. Close below. Our slow and our fast are really tight in this range. But we get our closes below, a couple of pops above, then the breakdown, and we start rejecting the fast and heading lower, and the fast and heading lower. You can get a little pop above and a little uptrend that forms. Again, this is a 1-minute, right? Whereas earlier we saw it reject every 3-minute test. Now we can see some attempts to get through on the 1-minute, right? We fight up to it. We get a close above, quick rejection back. We hold higher. We start to close above again. Some retests, a nice little push. I just point this out because at any point, this could be a change, an apex, and we go back up through our slow to take off for the day. But as you are in that long and waiting to see, can't get through a key level, closes start to happen below, so you need to be wary for that change in trend back down, which we get. Can't get through this pocket from our fast holes. We ride it lower. And again, once you start to close through, buyers and sellers are going to start fighting back and forth on the algos. Nice little wave up, back near the slow, rejection lower, closes below, right? Starts the down wave. And as it continues to sell off, those slow holes are coming lower and lower and lower, so that the last push through is a little easier. And then you can see how we rode through on the fast holes right through the slow, right near the lows for a good response back up. Back here, there we go. So it works across different time frames. That's one thing that's very key because we could be watching a 1-minute and these fast holds and start to see a breakthrough, but not realize that the 3-minute is sitting right there as resistance also, right? So for that case, I have another chart that I've set up with a set of whole moving averages that I've built to show across multiple time frames. So we were just looking at SPY, so let me set it to that. And we're looking at a 1-minute. Let me give it, yeah, let's just look at the 1-minute for Friday. So, come on. Don't freeze on me. Oh, man. Totally freezing on me. There we go. There we go. So on this chart, what we're looking at is I have a 35 moving average from the 1 minute. Then I have a 35 from the 3 minute, the 10 minute, and the 15, right? So I have the same whole moving average from multiple time frames. If we look at SPY, we were kind of riding down, let's say, the slower, higher time frames, the 35s, right? We got a pop above, we held, we start to ride that trend up. The 3 minute right here is support that's trying to get us to break out. But once we start closing below the 1 minute and then below the 3 minute, we can't get back through after that. We try to hold the 10 minute and 15 minute, which are sitting right here. We even get one last pop through, but can't get going or close above that 3 minute hole, right? And then it's down for the sell off on the day. We ride the 1 minute down. We try to get going through, but the 3 minute is still way up here. We can't even get to that. We start to break below the 1 again and ride it down. Again, we get through the 1. Now we're getting through the 3. We get some retests of both as they are flipping to try to become support. We only get one close. If you look, once we closed above that 3 minute, even though we did have lower, we didn't close a candle below until this low of day. Close the candle below, then back above, and once we get through that 1 minute, both are apexing together to give us that ride up. Again, this is just trying to show how a 1 minute versus a 3 minute and a 10 and a 15 can be the same kind of support and resistance, and a close on the other side can mark the change of a trend. So we started with a 3 minute where you saw we rode the 35 and the 55 down till we changed into an uptrend. Now we're looking at a 1 minute, 3 minute, and 10 and 15 just to show how you get kind of the same interactions. Just to say you could stay on one time frame looking at multiple time frames with these tools, or you could just stick with one time frame and using a slow and a fast of that given time frame. Because as we saw, that we couldn't get, and we're rejecting the 3 minute on the way down, 3 minute 35 on the charts that we saw earlier. That could be overlapping with a 5 minute or a 10 minute or a 15 minute MA. Not to say that you need to check all these time frames or anything like that. That's kind of why I have a couple of different flavors of MA tools that I will be outputting with this video. One is this multi-time frame MA, where you can set it to your current chart, and you can grab some higher time frame MAs to keep a track if you want to play against a 1 minute break above against the 3 minute that is resistance, right? That's one way to do it. Or you can stick to one time frame and just have your fast zone and your slow zone, and say I'm playing a break above the fast to get back to the slow, and it's failing, so I continue back down. Then I do it again. We almost got to the slow, failing, back down. I'm going to do it again. Now we're breaking through the slow, and I can ride this uptrend from 473. What did it break through here? 473 and a half-ish. Can ride that uptrend up to 475. Once it breaks back above here at 474.75, I can ride that uptrend again, right? So key things to take away, the timing aspect of holes and when they get to key levels, the close above and below to mark the beginning of the change of trend, and when algos are going to turn on, right? Just like right here, once you get that close below and you can't get back above like you did over here repeatedly, where you close below and you get a pretty quick response in a couple of candles to get back above. Once that happens over here and you can't get back above and you're making an H, that's where algos are adding to. The sell-off is on because we made an H and we're closing below. And we ran into the slow. Now we're going to try to get through. Can't get through. More selling. Hey, we got through just a few candles, but the next close below, bigger selling, right? The volume starts to step in. You look at the volume. We're coasting pretty slow here. We get some closes above, but once we get this close below, boom, here's a big shot of volume that's taken us through that buying wall at the open level, right? So let's see, any other points over here? Holes kind of have that set of rules for support and resistance. If the holes are below and price action, there's support. When we start to close on the other side, that signals the shorts. Rejections to get back above starts to confirm the shorts. And then new candle to candle lows move into profitability for shorts. Just like we see each time I say making an H, right? Buyers step in, can't close above. We make the H. That's profitability for everyone that shorted. Doesn't matter if they shorted at these low wicks, at the opens, at the high wicks, at the closes. Everyone that just shorted in this pocket just got confirmed at that new low, right? That's why I try to say over here, a close below starts to signal the shorts. Rejections to get back through starts to confirm, and then new candle to candle lows is profitability. And they got in at the turn, whereas with something like an exponential moving average, you might already let this pullback happen, and then let this pullback happen before you're finally getting in. Whereas with a hole, the break below and close below, you're starting to short, and it's working. And every bounce back, the longs can't get going, so you're waiting for the next close below, let's short, boom, 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 confirmation, can't get back through, new lows, further confirmation. So remember those rules, very simple set of rules with holes. And given the nature of that change in trend, you can set up those limited risk trades. For instance, let's say, here we go. Let's say you tried, let's zoom out a little bit. Thank you. Let's say you start to see these closes above. You wait and you wait, and you start to get that strong pop. Wait for that close, try a long. Your limited risk is basically from this open at around 474, right? Against this low and this MA, which is 20 cents lower. Just call it 25 cents. So you're basically risking a quarter to try to go make a buck, right? Every time that you get that change in trend and the close is over and the retest of the MAs, it's usually a low risk against something like a recent low or a close back below. Let's say you didn't position here, it starts to break above and close above. You get these pullbacks and you say, I'm going to get in at this flag. Maybe I'm not going to risk the retest. If I get the retest, I'll get in, but instead I'll just risk a break above, right? So I'll put a buy here. You get through, it starts to work, you lock profit, you get on any retest, and you're following. I mean, I could pull up any chart and look at an interaction with a hole and come up with a thesis as if I were live and watching, right? We're getting a good response here. We're riding up. Can't get a close below. Once we get a close below and a second, you can start shorting. You get some reaction from that close below and no more closes above like these quick reactions we got on the last test. You're getting some confirmation. Let's say you try to short again around here, but you're getting closes above and it's not doing that quick reaction back below. Close your shorts, switch long, yada yada. So point being, when they're getting those changes below and above the MAs, it can be a very tight risk against recent highs and a close back above or a close back below or whatever. And when you wait for your MAs, like let's say these slow MAs, to get down near the lows before you start risking longs, you can see that once you start to get the closes above right here, 473.80, low of day is 473.3, so you're risking 50 cents to try to fight back. So you can get a nice measurable risk on your trades. We talked about the timing and getting to key levels. I like to let the price action and the fast holes get to a key level before I start to risk at a pivot from that level. The timing on the whole is, from my experience, a little more conducive with the algo trading environment that we find ourselves in. And if so much time has passed and we don't see continuation with the holes and we start to see closes below the holes, we can see a pivot and a retracement. But the only thing I didn't talk about was the vacuum effect. So let me give an example. When we finally do test these slow holes that we hadn't tested since way back in the beginning of the day, we don't get any retests. We get a close above and a straight path up to the next one. That is what I like to call the vacuum effect. You can even see it on the slows, or I'm sorry, the fast holes that hug a little closer, right? But that's a great example on the slow holes that are cutting through here. We get a close above, and there are no low wicks that come back to retest that close above. It's just straight up and vacuumed through those moving averages. Let's see if we can find another example with the fast. Let's go back. Okay, so here's an example. We close below this fast. We can't get back through on the next close. So if you bought this, if you shorted this open, you get the vacuum straight down to the next one. Well, that's not a big move, right? Time and time again, that can become part of your thesis, right? We got to break through when we didn't have any closes below. The next candle can't close above. So if you, let's say, had an algo trained to buy the close below, then buy the next candle's close if it doesn't get above. You're already in a 2 lot. The next candle breaks through both of those, so you're profitable, and it vacuums to the next. You can close your whole position there to say, I got in a 2 lot, pretty much doubled from my average down to this close, and it created fulfilled the vacuum, right? Close the whole lot. Let's see what happens next. So the vacuum effect is something that's very interesting and something you'll see with whole moving averages. It doesn't always happen, right? But you can see here's a close below, vacuum down, right? Let's see, we got a close above, vacuum through. So it can happen time and time again. I'm sure we can find examples where it didn't quite happen. Let's see. We got this close above. We got the quick response against the non-vacuum through, if you will, and we rolled over. We got, let's see, this open above, kind of vacuumed up. Where's another example of not fulfilling a vacuum? I mean, yeah, it's not a good example. Either way, that was kind of one of the other points I just wanted to give where, here you go, like a little close above, quick rejection. We didn't get the vacuum through. That can happen, obviously when we reject the faster MA. So either way, I think that covers most of the points I wanted to get with the whole moving average. I'll be providing with this video that I've posted and that you've watched links to import the tools that I've built. I guess the last one I should show is the hybrid tool. Am I going in the right direction? Yes, I believe I am. Let's go back to ready since that's kind of what we started with. Just to show the hybrid tool that will be included as one of the available options. With this one, I have a fast hull. I have the slow hull to provide the two clouds. The dash line is kind of just meant to be, in a way, a midpoint or a last line in the sand for a change in trend. And then the fast cloud is broken up between, kind of your faster portion where you'll see rejections for continuation, your slower portions where they're trying to break through. Overall, let's see if we can go back to a good uptrend. It's not really showing here, but when you get a nice spread like this and the clouds are thick, when you get a good continuation up, you can reach into this green zone, and that's where the buyers are really stepping in. They kind of let it get through the purple zone, right? So in a way, this is just for me to have a little bit more clarity, let's say, on the fast cloud versus slow cloud by kind of putting a midpoint through that cloud and it allowed me to understand, is this going to be a rejection quickly? If we close inside of it, do we get the vacuum effect? Should I short that vacuum effect? One thing to note when it comes to Hull moving averages, when the rise over around the slope, right, of this cloud is so extreme, it's going to be harder to get through. And we usually write it down until we're just sitting in it for so long and then closing above that it starts to flip. So, when we have a sharp down slope, when we're getting up and testing it, I'm not trying longs there, right? But when we're grinding through it, then I'm like, okay, I think buyers are about to step in, right? Then we get through the last straw. We don't even get to retest the last straw, and we're holding the purple. It just means buyers are strong, buyers are strong. The next decent pullback gets into that second portion of the cloud, where it's like buyers really, really have to step in here to continue at all. And then obviously we went sideways so long that it starts to flip and become resistance. And if you just looked at this midline at the start of the day, if you shorted these closes below, wrote it down, and didn't go long until you started getting closes above, it pretty much kept you short down near the lows. It got you going long as much as the bounce got, and then when we started closing below, the next sell-off. I like to use that dashed line as the overall midpoint of the trend, if you will, because there's always a fast trend and a slow macro trend. So this hybrid tool will go out as well. And obviously the Hull moving average exists in Thinkorswim. You can pull it up yourself. Just go to add a study and type in HULL, and it'll pull up a average Hull moving a normal Hull moving average. I believe actually this chart is nothing but the normal one that comes in Thinkorswim, right? Where I set the 35, the 35, the 55, and the 350 and the 550, right? So that's in Thinkorswim. I will be dropping my multi-timeframe one so you can have a 1, 3, 5, whatever you want on the same chart. And then I'll also be dropping my hybrid tool, which is kind of like all my favorite moving averages in a visualization that I prefer. So thanks for tuning in, and hopefully everyone finds this helpful.